What if the safest market in the world is starting to show cracks and almost no one is talking about it? In the middle of the AI boom, the biggest tech companies are borrowing money at a pace we haven't seen in years. They're racing to build data centers, servers, and huge AI systems before their rivals do. But all this borrowing is doing something unexpected. It's putting pressure on the investment-grade corporate bond market, a place that usually stays quiet and calm. By the end of this story, one thing becomes clear. The AI revolution is running on debt, and that debt may be turning into a warning sign. Why are tech companies borrowing so much, so fast? Over the last few months, giants like Meta, Amazon, Oracle, and others have raised tens of billions of dollars. Reuters reported that AI-focused companies issued around $75 billion of investment-grade debt in just 2 months. That's more than twice what they'd normally issue in an entire year. 2. The reason is simple. Building AI at this scale is expensive. Data centers need land, power, cooling chips, networks, and massive construction. And the cost is rising faster than even these giant companies can handle with their regular cash flow. So debt becomes the shortcut. It lets them build fast, stay competitive, and keep pushing the limits of AI. There's also the shift in spending. Instead of putting money into buybacks or safer long-term projects, tech companies are pouring billions into AI hardware. Capital spending across the industry is hitting record highs. Entire regions are dealing with power shortages because companies want to build so many data centers at once. The race is intense. Everyone wants to own the future of AI. And missing the moment could mean falling behind forever. The outcome is easy to see. Even the richest tech companies guarantee have enough cash to keep up with the pace. Debt is the only way to keep the engines running. But when borrowing explodes this quickly, it does more than build data centers. It changes the bond market itself. And that brings us to the stress showing under the surface. The investment-grade bond market is where most big companies borrow money. It's supposed to be safe, slow, predictable, but now it's being flooded with new bonds from AI-focused firms. One red flag is credit spreads. When risk rises, spreads usually rise too. But today, spreads are unusually tight. Investors aren't being paid much extra to take on this new risk, even though companies are loading up on a lot more debt than before. Some major investment managers have already warned that pricing no longer makes sense. The risk isn't reflected in the yields. Another problem is supply. Too many bonds hitting the market at once can push down prices or make borrowing harder for other companies. Tech firms are drawing so much cash out of the system that the market feels stretched. Their capex to cash flow ratios are climbing toward 100%, meaning almost every dollar they earn is being spent. That leaves very little room if something goes wrong. Even central banks have pointed out that if the excitement around AI slows, or if interest rates rise, the market could shift suddenly and sharply. For a place built on stability, the early tremors are hard to ignore. That leads to a bigger, more dangerous question. What happens if AI revenue doesn't grow as fast as expected? This is where the real risk hides. The AI boom is full of hope, but the payoff takes time. If companies don't see strong returns soon, they'll be stuck with massive piles of debt that need to be refinanced. Refinancing is simple when rates are low, but today, rates are higher than they've been in years. Rolling over debt becomes more expensive. Profit margins get squeezed. A company that planned to pay a tiny interest rate now has to pay more, sometimes double or triple. Across tens of billions of dollars, that shift is huge. Once big tech firms start feeling pressure, the entire bond market feels it too. The investment-grade market is held by pensions, insurance companies, retirement funds, and major financial institutions. If confidence drops, spreads widen, yields spike, and the value of existing bonds falls. It can move quickly. A place that once felt safe suddenly becomes a center of fear. And because these markets are all connected, trouble in tech bonds can spill over into other sectors. Manufacturing, retail, banking, even municipal financing. Stress moves like a shadow, quiet at first, then everywhere. There's also another layer to this story that most people don't see. The hidden infrastructure strain behind data centers aren't just buildings filled with machines. They consume huge amounts of electricity, more than some small cities. They need cooling systems that run every second of the day, backup generators for emergencies, and massive water systems to control heat. As companies borrow more to build these facilities, a new risk forms in the background. If power shortages happen or if energy costs spike, the whole AI rollout slows down. But the debt doesn't slow down with it. Companies still have to pay interest even when the data center isn't running at full power. That mismatch between debt and performance can hit balance sheets fast. But the pressure doesn't end there. Every big tech company wants to win the AI race. They want the fastest chips, the largest model clusters, and the best infrastructure. But racing this hard forces them to borrow even more. It becomes a cycle. Borrow to build, build to compete, compete to survive. The more they borrow, the more the risk grows. And in an industry where technology becomes outdated in months, companies can easily end up with billions invested in systems that become old faster than expected. A small delay, a weaker product, or a shift in strategy can turn a massive investment into a heavy burden. Investors are watching another new trend rise alongside AI: private credit. When companies don't want to issue public bonds, they borrow from private lenders. This market has exploded in size, and the AI boom is one of the main drivers. The problem? Private credit doesn't have the same transparency or rules as public debt. When companies borrow too much in private markets, the risks stay hidden. If something goes wrong, the shock can hit the financial system without warning. And because so much private lending is tied to future growth expectations, a slowdown in AI spending could shake that market too. Pit all of this together, and the picture becomes clearer. The AI borrowing binge isn't just a financial story, it's a structural story. The world is building a massive new digital backbone, but it's being built with huge amounts of borrowed money, rising competition, and a lot of pressure. The hope is that AI grows fast enough to justify the cost, but hope isn't a guarantee. Now, the bigger picture finally comes into focus. The AI borrowing wave and the pressure building in the investment-grade bond market are linked. One drives the other. Tech firms need to innovate fast, so they borrow. But the more they borrow, the more strain they add to the bond market. If AI delivers giant profits quickly, everything works out. Debt gets paid, markets stay stable. But if the payoff takes longer than expected, even by a little, the stress that it's been building in the safest part of the credit world could spill out and reshape everything. Here's the truth at the center of all this. Even in the calmest corners of finance, risk never disappears. It hides. And right now, it's hiding inside the walls of the world's biggest data centers. The investment-grade bond market is where most big companies borrow money. It's supposed to be safe, slow, predictable, but now it's being flooded with new bonds from AI-focused firms. If this helped you understand what's happening behind the AI boom, hit like so more people can see it. Drop a comment with your thoughts on whether this borrowing wave feels smart or risky. And subscribe for more simple, powerful breakdowns of the biggest financial stories shaping the world.